So now we already know our risk per trade, which is 5% of our $100, which is $5. We already know the distance between our entry price and our stop loss, which is 2.7% away. We already know our target. So what we are trying to get now is how much are we going to put on this particular trade. So the amount we are going to put on this particular trade is, okay, if I'm wrong on this trade and I lose 2.7%, so the 2.7% I'm going to lose should be equivalent to my risk per trade. So the 2.7 must be equivalent to $5, which is my risk per trade, right? Which is 5% of $10. Do you understand? So now, how do we calculate the position size? So there's a formula to calculate the position size, and this is the formula. So we have our total equity. What is our total equity? Our total equity in this case is $100. Our risk per trade, which is 5%, so that's 5%, divided by the distance of stop loss from entry. We already know that the distance from stop loss to entry is 2.7%. So how do we do it? We know that total equity multiplied by risk per trade divided by distance of stop loss from entry, right? So we know that our total equity is $100, right? Then our risk per trade is 5%. So 5% is 5 divided by 100, right? Which is 0.05. So 100 times 0.05 divided by distance of stop loss to entry, right? The distance of stop loss from entry is 2.7%. So 2.7% is 2.7% divided by 100, right? Which is 0.027. So that is how you calculate position size. When you calculate this, what will it give us? Let's bring out our calculator. That's 100 multiplied by 5%. 5% is 5 divided by 100, which is 0.05. So you get that is 5. So inside this bracket, we have 5, right? Let's keep that in mind. So divided by distance of stop loss from entry. Distance of stop loss from entry is 2.7%. 2.7% is 2.7 divided by 100, right? That is 0.027. So we already have our result of this bracket, which is 5. So we are going to take 5 divided by 0.027. So what do we have? We have 185. So your position size for this particular trade should be $185, right? $185. And why is it $185? We already used our formula for position size to calculate how much to put on that trade. So how does this work? So if we put $185 into this position, right? If we are wrong, it means by the time our stop loss is triggered at 2.7%, we are going to be losing just 5% of our capital, which is $5. So 2.7% of 185 will give you $5. So if we take this trade and we are wrong and we lose 2% of whatever we are putting on that trade, we are going to be losing a maximum of $5. So that's how you calculate your position size. Let's do another example. So in this example, let's say we have a $1,000 account, right? How do we calculate position size for this kind of trade? We already know our target, which is 11.25% away. We already know the distance between the entry and the stop loss, which is 3% away. And then we already have our capital, which is $1,000. So if we want to calculate the position size here, it will be total equity, which is $1,000 multiplied by a risk, right? Multiplied by risk. So what is our risk per trade? Don't forget, your risk per trade is fixed, which is still 5%. So you don't want to lose more than 5% of your total capital per trade. Our risk per trade is 5%. So 5% is 5 divided by 100, which is 0.05. We already know our total equity, which is $1,000. We already know our risk per trade, which is 5%. 5% is 5 divided by 100, which is 0.05, right? So divided by distance of stop loss from entry. So the distance of stop loss from entry is 3%. So 3% is 3 divided by 100, which is 0.03, right? So let's calculate this. Our total equity is $1,000. multiply by the risk. Risk is 5%. 5 divided by 100, that's 0.05. That's times 0.05, right? So that's 50. We already have 50. Let's keep that in our mind. Divided by our distance of stop loss from the entry, which is 3%. So that's 3 divided by 100, which is 0.03. You take the 50, which is the result here, divided by 0.03. So that's 50 divided by 0.03. So for this trade, you are going to be putting $1,666 on this trade. So on this trade, you are going to be putting $1,666. So let's say this trade goes wrong and the distance between your entry price and your stop loss is 3%. So if the trade goes wrong and you lose 3% of this particular amount, which is 1,666, you are only going to be losing 5% of your total capital, which is $1,000, right? So if you calculate 3% of 1,666, it will be equivalent to 5% of your total capital, which is $50. Do you understand? So that is how you calculate position size. Please don't forget, in any trade, you want to first determine, okay, where am I entering? Where is my stop loss? Where is the place I believe I'm wrong? If the trade doesn't go my way, where is my target? And then what's my total equity? So that is how you calculate a position size. So the example I put here is a trader has $50,000 in his account and wants to risk 3% of their account, and the stop loss is 5% away from their entry. The calculation is the result you have here divided by 0.05 will give you 30,000. So what you are going to be putting on this kind of trade is $30,000. So the risk per trade and position size are quite distinct. A trader can trade with $50,000 account but can have a $30,000 position size while risking only 3% of his capital, which is 1,500, which is what we did here. So for effective trading, it is better and it is best for a trader to know their risk per trade and their stop loss placement before they even enter the trade at all. So you won't be scared if the trade goes wrong. If the trade goes wrong, you already know how much you are losing on that trade. And if the trade goes right, you already know how much you're going to be making on that trade. So that's position sizing. The reason why traders fail in the market is that they do not calculate their stop loss, they do not calculate their position sizing, they just enter the trade. So, for example, you have $1,000 in your account right now, that's the maximum you have in your account. You are taking this trade now, so you need $1,666 to enter this account. For margin trading, all you are going to tell the broker is you want 1.7 times leverage. That means you want to trade with 1.7 times of the money that you have in your account. So for margin trading, you are going to fill in 1.7 times leverage. They are going to borrow you this money, and then you can trade with 1,666 or 1,700 in the market. Do you understand? So that's how position sizing is calculated. Formula is here. Please always calculate your position size before entering a trade. And for you to calculate your position size, you need your risk per trade, the distance to your stop loss from your entry, and you need your total equity, the total amount you have in your account. So it's basically total equity multiplied by risk divided by distance to stop loss from entry, right? I hope you got this. So guidelines to position sizing. I told you that when you have $100 or when you have $1,000 in your account, you don't want to be leveraging, or you don't want to be using the whole $1,000 as collateral to take a position. For someone that has $1,000 in their account, the person or the trader must not use more than 25% of his total portfolio, which is $1,000, to take a single trade. Do you understand? So let's say I want to buy Bitcoin, for example, and I have $1,000. When I want to enter that position, I should not use more than 25% of my total portfolio to enter that trade. The reason is, if you use your total amount to enter a trade, by the time you see another opportunity in the market, you won't have money to enter that position. Is either you close the previous position and then enter the new opportunity that you just saw. So always use 25% of your portfolio to trade in a particular position. So by the time you see more opportunities, you have more money on the table to trade. Second one is you must not risk more than 5% of your portfolio in a trade. So on a trade, you must not lose more than 5% of your money if you are wrong. Please, you should understand this. You should put these two rules in mind. You must not use more than 25% of your capital as collateral to enter a particular trade. And when you are trading, you must not lose more than 5% of your capital per trade. Do you understand?